Whiplash in the trade war, how Trump is rolling back tariffs.
Tariffs.
What impact will this have on the everyday citizens of the United States?
Tariffs. They're making headlines, fueling debates, and shaking up financial markets worldwide. From global supply chains to inflation concerns, the ripple effects are being felt everywhere. But while today's trade battles may seem like uncharted territory, the truth is, tariffs have shaped America's economic landscape since its very beginning. For centuries, the US has used tariffs as a tool, sometimes to protect domestic industries, sometimes to generate revenue, and at other times as a weapon in broader geopolitical conflicts. From the tariffs of the Great Depression to trade disputes of today, each era has seen the same questions resurface. Do tariffs strengthen national economies, or do they weaken global trade? Are they a shield against unfair competition, or a double-edged sword that risks economic retaliation? But this time, something feels different. In an era of globalization, digital markets, and economic independence, tariffs are no longer just about trade. They're about power. With the US dollar as the world's reserve currency and economic leverage at an all-time high, tariffs are now a strategic tool in a much larger game. But how do we get here? What can history teach us about the cycles of trade wars and economic conflict? And most importantly, what comes next and how does this affect you? In reality, America's relationship with tariffs is just as old as the country itself. In fact, during the early days of the Republic, tariffs weren't just an economic policy. They were the backbone of the government's revenue. Before the introduction of the federal income tax, the US funded itself primarily through tariffs, using them to protect fledgling industries from foreign competition. For much of the 19th century, high tariffs helped American manufacturing grow, shielding domestic producers from cheap European goods. This protectionist approach allowed the US to build a strong industrial base, but it also created tensions, with some arguing that tariffs benefited the northern industries at the expense of the South. This added to the economic divide that would eventually lead to the Civil War. But by the early 20th century, the US was shifting away from tariffs as its primary source of government revenue. The passage of the 16th Amendment in 1909, which was officially implemented in 1913, introduced the infamous federal income tax, fundamentally changing how the government funded itself. With a new stream of revenue coming directly from individuals and businesses, tariffs were no longer as essential, and the US slowly began integrating more into the global economy as a result. However, that shift became even more dramatic in the 1930s, with one of the biggest tariff-related disasters in American history, the Smoot-Hawley Tariff Act. This act was designed to protect American jobs and industries during the onset of the Great Depression, but instead it backfired spectacularly. This is because in response to this act, other countries retaliated with their own tariffs, leading to the collapse in global trade and making the economic downturn even worse. So what was supposed to be a safeguard for American businesses actually ended up cutting the US off from the international market at a time when it needed global trade the most. Overall, the lesson of Smoot-Hawley reshaped US trade policy for the rest of the 20th century. Instead of protectionism, the US embraced globalization, prioritizing trade deals that lowered barriers rather than raising them. The creation of NAFTA in the 1990s and China's entry into the World Trade Organization in 2001 further accelerated this trend, leading to outsourcing of manufacturing and the rise of global supply chains that we see today. Because of all this, tariffs, which were once a cornerstone of US economic policy, became nothing more than an afterthought. But now we're starting to see a shift back. The US is once again using tariffs as a tool to reshape global trade under the Trump administration. But this being said, a crucial question remains: are we correcting past mistakes, or are we instead on the verge of repeating them? For decades, corporations have played the game of globalization to their advantage, setting up factories in Mexico, China, and other low-cost regions in order to sidestep tariffs and maximize profits. This wasn't just a business strategy, it was a fundamental shift in how American companies operated. Manufacturing moved offshore, labor costs dropped, and profit margins soared. But while corporations thrived, American industries suffered. The US went from being the world's manufacturing powerhouse to a country increasingly reliant on foreign supply chains. And the result of this was the entire towns built around factory jobs were simply hollowed out and millions of workers were left behind. But now, that tide is starting to turn once more. The US government is actively pushing to bring manufacturing back home, offering massive incentives to companies willing to set up domestic production. Just over the last 30 days, big names like TSMC, Apple, and Honda are making big moves to America once more, bringing trillions of dollars in direct investment with them, planning to build factories in states like Arizona, Ohio, and Texas. And let me emphasize, these are not just some small-scale projects. We are talking about hundreds of billions of dollars that are being poured into new facilities, and the government is ensuring companies have every reason to stay. Firstly, the motivation behind this shift is clear. The pandemic exposed just how fragile global supply chains had become, especially with China. The risk of over-reliance on foreign manufacturing is no longer just an economic issue, it's a matter of national security. By reshoring production, the US is trying to regain control over critical industries, ensuring that supply chain disruptions or geopolitical tensions don't leave the country vulnerable. But of course, change is never easy, and people of course are hardwired to resist it. And nowhere is that more apparent than in the US economy. For decades, offshoring production in the name of efficiency and profits have been the standard playbook for businesses. But now, that system is being challenged, and the transition won't be smooth. Reshoring means higher costs, supply chain adjustments, and the difficult reality that domestic manufacturing doesn't offer the same immediate profit incentives as cheap foreign labor. And markets, which are always forward-looking, are desperately trying to make sense of this shift, with $3 trillion wiped out from the US stock market in just the first week of March 2025. You see, every major structural change in the economy brings volatility, and this one is no different. That being said, let's take a look at how tariffs are impacting current market sentiment and what the future holds for crypto and other risk assets. The truth is, while uncertainty rattles investors in the short term, markets tend to follow a rather predictable pattern when it comes to this. Initial panic followed by adaptation, and the reason we know this is because we've seen it time and time again. When an economic shock hits, whether it's a major policy shift like tariffs or an unforeseen crisis like COVID, markets react with volatility as investors scramble to price in the unknown. But over time, businesses adjust, supply chains adapt, and markets find equilibrium. We saw this play out in 2018 when Trump's tariffs on steel and aluminum initially triggered a wave of investor uncertainty, leading to market jitters and fears of escalating trade tensions. But as companies adapted, domestic production ramped up, and those industries saw a temporary boost. The same pattern repeated in 2020 when COVID crashed markets overnight, only for stocks to rebound as stimulus flooded the system and businesses recalibrated. The question now is whether today's tariffs will follow past cycles of short-term volatility followed by eventual stabilization, or if this instead signals a much deeper economic shift. The only thing we know for sure right now is that this time, the market reaction is much more divided. Stocks tied to US manufacturing and semiconductors are rising as investors bet on a domestic production boom, while crypto and other risk assets struggle under uncertainty. And unlike 2018 when the economy was expanding, today's environment is far more fragile. Inflation remains high, making the Fed hesitant to ease monetary policy, and global debt levels are weighing on growth. Markets are caught between the need for more liquidity and policymakers reluctant to provide it, making this adjustment phase far more complex than those before it. The world is a global supply chain now more than ever, which means other countries are positioned to also put retaliatory tariffs on the United States, such as countries like China or even Canada, which have done so over the last week. China going so far to actually put a 100% tariff on products coming out of Canada on March 7th, 2025. The key question is when exactly markets will find their footing. If economic conditions soften and liquidity begins to return, we could see a similar adjustment phase play out, where risk assets rebound as investors reposition for the next growth cycle. But if trade tensions escalate and economic uncertainty lingers, this adjustment period could take much longer, reshaping market dynamics in a way we haven't seen before. Now, whether it's tariffs, manufacturing shifts, or market volatility, none of these forces exist in isolation. They're all part of a broader economic transition, one that's forcing businesses, investors, and policymakers to rethink the way global trade and industries operate. While the short-term uncertainty is driving market turbulence, history tells us that adaptation is inevitable. So whether today's tariffs lead to a manufacturing boom or simply just another phase of market recalibration, the reality is we are entering a new era of economic strategy. And this time the background is different. As the world adjusts to changing balance of trade, liquidity, and domestic production, one has to wonder, are we witnessing the early days of a new financial order where decentralized assets play a much larger role? Or will the forces of regulation and monetary policy ultimately dictate the fate of this transition? Either way, one thing is for certain: for better or worse, the decisions being made today will ripple through the economy for years to come.